Everybody, this is Jim at SP500chart.com. It's Sunday afternoon, and we're going to take a look at what happened this past week in the S&P 500. Let's do this first. Please pause your video and read this and take it to heart. Normally I would read that for you, but I'm trying to give my voice as much rest as I can. It was actually better today. So I'm hoping I'm on the upswing. Please read that, then we'll take a look. Okay. The week, we saw some down, we saw some up, and we are now actually at a new all-time closing high. We have yet to make the intraday high that was hit back at the end of April. But you'll recall that was a big negative candle on I believe it was the 27th, where we gapped up to roughly quickly ran to about 21.25, and before the day was over, we had given up all of that and a good bit more. In contrast, we are now at 21.22 and have spent the past roughly about a day and a half around that level, as opposed to that little brief trip to those levels back in April. We pointed out the potential of all of this sideways action that has taken place this year. And I'm including this back here too, what we saw in early January. We've made note of the fact that there have been potential patterns all through this. And each time one would develop and it would look like we would be ripe for either a break out to the upside or a break down to the downside, something would happen that would throw a monkey wrench into things. So far we have not seen the monkey wrench, at least not this past week. We opened the week over our red line, but you'll recall we never did get over this line by a technically significant margin. We got over it on Friday. We opened over it on Monday. But by the end of the day Monday, we had come back and just under that line. Then Tuesday and Wednesday spent almost all of the trading under it. Thursday got over it again. Friday stayed over it. Now, during this past week, we added an additional trend line. We added this purple line right here with the idea that all of this sideways action, since really pretty much the first of the year, but especially since February, that all of this sideways action may have morphed into a continuation pattern in the form of an inverted head and shoulders. That's a little bit of an odd place to see it, perhaps. The reason I say so is usually we would see a continuation pattern after a nice move up. Not after a nice move up and then a few months of sideways. Or we would see an inverted head and shoulders pattern after a nice move up and then a significant move down. Not after just going sideways. But it is what it is, and if we continue to see some buying pressure this week, it may work out to be just what it looks like it is. So for now, I'm looking at this line, and I'm looking for a technically significant move over it. Not there. As a matter of fact, this line is currently at 21.14. Add 21 points to that, and we end up at roughly 21.35. So we're not significantly above that line until we get up to about right here. So roughly 21.35. If we do that, we will also be technically significantly above our red consolidation line right here. And I still look at what we saw develop through February, March, and April, and so far a lot of May. I still see this as being a general shape of a pattern that should give us a target. And like I said before, we got a target up here in the 2190s. So if this inverted head and shoulders pattern plays out, we will be technically significantly above this line. We will be technically significantly above this line. I think being above this line points us to 21, actually the mid to high 2190s, and being technically significantly above the purple line, which would have broken out on Thursday, assuming we continue the move upwards and reach technical significance. We have a target around 2167 to 2168. So the good news is, and I'm going to make this fairly brief, because we're not out of the range yet. Sure, a new all-time closing high, great, but still not technically above either of these lines by at least 1%. But I look at the week as being the strongest sign yet that we are ready now to get up out of this doldrums and to make a significant move upwards. The caveat, what for those of you who may not know, because not everyone who reads this site not everyone English is their first language. A caveat is basically an excuse or a disclaimer in itself. The caveat here for what I said about this being the best sign so far is still that 1% margin. So, for now, to get over this line, technically significantly, we need to get up to about 21, what was it? This is at, pardon me. This is at 2107. To be technically above this line, we need to be up here at about 2130, 2129. To be technically above this line right here, 2114, that's the one that we need. I think we need to get on up to that 2135, 2136. So hopefully the markets have the strength to make such a move. I am going to get rid of this trend line for now, but I'm not going to do it by erasing it. I'm just going to move it. We're going to go with this as a potential support line. And why would we do that? Well, other than the fact that we have 3 touches on this line, we also know that one of the rules of trading an inverted head and shoulders pattern is to place the trade, a long trade, once you get above the neckline by a technically significant margin, if you wait for the pullback, you either wait for a return to the neckline or to a return of the trend line drawn from the head across the bottom of the right shoulder. Whichever one happens first. There's a third one, but I don't think that third one is going to come into play. If it does, I'll mention that in another video. So, to make a long story short, good week. We really didn't finish up that much, but the fact of the matter is we finished over a couple of trend lines that had been holding the market back for quite a while. So even though the week itself, if we take a look at this on a weekly chart and we zoom in, you can see ain't much, really not that much of anything happened there. Interesting to note, you see this pattern back here, that's a hammer. That October of 2014 made a nice hammer. Here we made a hammer, never really got much lower than the low of this. The past 3 weeks, even though they have not been at the bottom part of a range, have that same shape. Now the case could be made, some people say this wouldn't be a hammer, this would be a hanging man, which has a bearish implication, but we did not get the confirmation on a following week as far as the candlestick charting goes. So to see 3 of these tells us that each week we came down but then came back up, came down, back up, came down, back up, which tells me that the S&P wants to go higher. Each time it comes down, it finds support and then comes right back up. So let's keep our fingers crossed that starting the week of May 18th, that this would be the week we see nice gains. The only other thing I'll mention is I'd put a couple of short-term trend lines on the chart this week. They sort of pointed the way to where we are now. This is one right here, with the idea being if we get over this line, we should start a rally up. And I don't mean just getting above it and then that's the rally, but I mean we get above it and then we start to see at least a few days of rallying action and potentially more. So it was a good week, guys. I appreciate you taking time to watch the video. And I really appreciate your support. And hopefully we'll have more good news as this week unfolds before us. Take care.